welcome to another edition of the Energy Week podcast. We are back for 1 week. We'll be off next week and be back again for regularly scheduled programming. Should be moving forward. Ellen, I was in Nicaragua. You were in the Middle East. Where were you? I saw it on Twitter, but I can't remember where now.
Let's see. I was in Saudi Arabia, and then I was in Dubai, and then I was in Bahrain. So I basically hit everywhere except Kuwait and Qatar, and I guess I didn't hit Oman either. So next time.
One thing that our absence did prove is that when we are gone, the markets do move and things do happen, and we will talk about. I don't know. Did you hear about this Aramco IPO deal? Did you happen to hear about that?
You know, something maybe in the back of my mind. I don't know.
Yeah, fitting that they dropped that news right when we're off, and it means that I take the L on the Aramco bet. I told the listeners to trust Ellen, that I would be wrong. I took the L on that. Ellen is right. Assuming they do go through with it, I'm holding out small hope that I could still be right on that, but it's not looking good for me. We do have on Dean Foreman today. Of course, we are going to talk about the Aramco IPO extensively as we can. I'm sure when I come back for Thanksgiving week of Thanksgiving, we'll be back on at the end. But let's start off first with some news that broke, and it was interesting. We just covered a story about this, Ellen, on the Textile and Gas podcast a few weeks ago about the lack of new discoveries, and this is something that's been out there for a little while. During the downturn, folks were worried that there wasn't enough investment going into these projects. They weren't going to find enough barrels to replace the current usage. I think it was like 1.6 or something is the replacement rate right now. But anyways, then the Iranians magically come out with 50 billion barrels of oil over the weekend, Ellen. And as I said on the show this morning, I'm not exactly sure how we should think about this, because it is Iran. So do we think that they have 53 billion barrels of oil just sitting there that they've discovered, or is there something more to this? And being that you're just in the Middle East, it's very appropriate timing for to get the sentiment around stuff like this.
Okay, so this is really interesting. So there are a bunch of interesting things going on here. One is that they timed this announcement to basically coincide with the Aramco IPO. So there's kind of a whole lot of, well, what are you trying to do there, Iran? Right? Like interestingly timed announcement. Also, what was interesting was this was like an announcement from the president of Iran, not from the oil ministry. So he makes this announcement. But then we have the oil minister who comes out, a day or two later and says, so this new discovery actually only added 22 billion barrels of crude oil to previous estimates of this field. So it wasn't like it was a brand new field.
Right.
It was a field that I guess they already knew, or I don't know. They said that the newly discovered oil field in Khuzestan was named Namavaran, and added that the field had oil in place estimate of 53 billion barrels. So oil in place is not necessarily recoverable barrels. Am I wrong about that? I mean, sometimes I feel like people throw around different terms and they're not really being so accurate. And they throw around whatever term fits them best. But my guess is with this that they're talking. So I was reading more about this, and I was looking at the Twitter thread that was posted by this guy who's covers oil. He's an Iranian journalist who covered oil for an Iranian oil publication, and he said that the field is estimated to hold 53 billion barrels of crude oil in place. They started exploring it in 2016. They had 31 billion barrels that they thought were discovered. They've added 22 billion barrels to previous estimates. But they're assuming a 10% recovery rate in the field, meaning 22 billion barrels of crude oil have been added to their production capacity. So this is even more curious. So they're saying now their production capacity is up. I'm really kind of honestly confused by a bit about this, but it seems like it's not all that they were saying.
Yeah, it is interesting because, as you mentioned, there's a variant of standards when you talk about this stuff. And on the show this morning, Textile and Gas podcast, it was interesting because we had someone come on, and I think he said that the number of the percentage of barrels or something like that was like 10 to 12% of the oil that they're actually getting out of the wells that they're drilling. And so that there's a lot more oil that's in the ground that they're just not currently able to extract for a multitude of reasons. And so if you take that and you say, okay, well, that's how does that apply here? And it's not necessarily clear because there are varying standards. And the other thing is, has this actually been independently verified, or are we just to take the word of the the Iranians are trustworthy people, I suppose, but I'm not sure I'm going to ready to go whole hog with them on this one.
Well, I would say that in general, like when we're looking at OPEC members' estimates of their reserves, it's none of those, possibly with the exception of Aramco, but we can hold that aside. So of Saudi Arabia, but none of them are have quite the veracity of, say, Exxon or Chevron or a publicly traded company that has to make disclosures for an American securities market. So like Venezuela's like, we have the most ever.
Right.
And everyone's like, okay, yeah, but is any of that actually, like, how much of that is really likely recoverable? How much of that is recoverable oil? How much of it is like possible or probable or all of that? And Venezuela's not saying that. So they're just self-reporting this. So yeah, Iran's going to self-report it and it'll change their OPEC stats, but that doesn't necessarily mean that it's like recoverable in any kind of interesting fashion. And so here's another interesting fact I learned. So remember, like I think it was last year, or maybe it was the year before, when Bahrain announced that, like, Bahrain, which is like an itty bitty oil producer, they produce like 40,000 barrels per day. And so they announced, we discovered this huge offshore it's an offshore oil field, for unconventional, like fracking. We're going to do offshore fracking. And it was like, whoa, big announcement. Oh my God, so cool. Halliburton's going to like do this. Yeah. So I learned recently that there's no way that field is ever coming into production anytime soon unless oil prices are like sky high, because it's so freaking expensive to develop that field.
Right.
And the whole announcement was timed with like a bond issuance that Bahrain wanted to do to basically like make themselves look good. So, I feel like you always have to ask yourself, and like there's a grain of salt that goes into all this stuff.
Yeah, and one of the drums I've been beating here lately, Ellen, and I think that ties in to this, is that, I used last night's game. The Vikings beat the Cowboys 28-24. We all know what that means, right? The Vikings win, the Cowboys lose. We know the score. We can calculate the touchdowns and all that stuff. And that's really all there is to it. The records or whatever, you can kind of dig into that. These announcements aren't like that. They're not a scoreboard. It's not 28-24. There's so many moving parts, and that's all the things that you're alluding to. And that's what makes it so hard to decipher, because in this industry, it's just not as simple as 28-24. We know who wins, we know who loses. It's, well, there's 50 billion barrels, maybe it's 20. At what price is it profitable? What kind of wells they can be drilling? Is there infrastructure in place? Can they export it? There's all these other things that go in there that make it really hard to decipher what this means long term. And we probably won't know for many years to come, what the actual implications of these so-called 50 or 20, whatever you want the number to be, billions of barrels of oil are, because it's just too far off, and there's too many variables, as you've done a good job of articulating.
Exactly.
So, speaking of things that we don't know a lot about, well, I don't know a lot about, you know a lot about, we have a couple pieces here talking about the Aramco IPO. Now, it was fitting that they honored you while you're there by announcing the IPO. I thought that was a nice honor they bestowed upon you to wait for you to get down there to announce that. I have seen a lot of comments about this. I've seen a lot of, obviously on Twitter, you've been kind of going back and forth over your thoughts on it. You are the Aramco expert, so you just tell us what you think from the announcement, which it kind of surprised me the way they announced it, all the way up to where we are as of, what's today, November 11th. What's transpired and what's been your kind of read on the situation?
Yeah, so this has been a very interesting time. I had a feeling they were going to announce it around the time of the FII conference, the Future Investment Initiative that was going on in Saudi Arabia. So, so I was prepared for it. I wasn't quite prepared with like the way that they went about this, which is obviously odd. Like everything they've been doing is quite odd. But it's interesting because they're not. So they finally released their prospectus, and it's a rather long. It's almost 700 pages, so it's not like I've had an opportunity to read it all yet. But it's one of the interesting things is that they didn't announce, the company's valuation or the share price. It seems like they're basically having this period of book building, and they're waiting to see what financial institutions are willing to pay before they go out and say, before they say, like, here's what we want. So we had a bunch of different, we saw the media release different banks value, like they basically gave them like a range of valuations. I think Bank of America's valuation range was like plus or minus $1 trillion. It was like a range of $1 trillion. So it's really an interesting IPO process. Interesting is probably the best word I can use for it. And, there are a lot of issues here. My biggest issue is really what they're doing to the Saudi economy through this. And I had a piece I'll link to in the show notes that came out last week, kind of going through some of the really big risks for the Saudi economy, particularly with how they're doing this. And they're not just encouraging like wealthy Saudis to invest, they're encouraging a lot of Saudi citizens to invest, retail investments. And it's beyond just encouragement. It's making money available for loans, offering, bonus shares if they don't sell within 180 days. I mean, really like a lot of incentives. And one of the interesting things that I observed when I was there, so, you go to another country and you go on Twitter and you start to get like Twitter ads for that country, usually in their language. Mm-hmm. So I started getting these ads for basically these companies that were saying, buy Aramco shares. This stock is going to triple in value by 2021.
Wow.
And I was like, holy crap. Could you imagine if someone did that in the United States? Could you imagine if Google was like someone advertised that for, like, they would be in so much trouble.
Well, remember when Elon threatened was going to sell the stock at $420 or whatever it was a few months back?
Oh, yeah.
They about killed him over it.
And so it's just like, it's like, that really brought home to me the like, I'm going to say it's like a lawless, because, everyone's like, oh, they don't have that much crime and all this, but it's like, it's kind of like the Wild West in terms of like the financial markets there.
So one thing I'm curious about, since you said that, and if we have a proper economist, can maybe if Ellen doesn't know, email in to the show and let us know. But it sounds like, if I'm following what you're saying, first off, it's very cumbersome for U.S. citizens to invest in this. There's certain methods you can use, but it's not really easy for us to do that. So if you're depending on the Saudi citizens and the Saudis themselves to invest into this IPO, without a lot of foreign money, it seems that the money is almost being circular. It's not really doing much. So is there a concern from what you're saying that because they're limiting listing on their own stock exchange, that because they're limiting the potential for outside investors to invest, that it could actually help the, I don't know what the right word is, if it would be distribution of income or whatever to the Saudis? Because if they had if they listed the New York Stock Exchange, for instance, you would have all these big companies in the U.S. theoretically who would invest. That's outside money being invested into a country that's across the world. That's a little bit different than your own citizens being the main driver of the investment. Does that make sense how I'm parsing that out?
Yeah, you've totally hit the nail on the head. So I'm just gonna I can kind of clarify some of the issues that go into for foreign investors. So retail foreign investment is you can't. Sorry, retail investors cannot invest in the Saudi Stock Exchange. So I can't just go on my Fidelity account and buy shares in Aramco.
And that's probably both sided, because for the U.S. side, it's tough to invest out, and probably they have their own laws as well. So it's probably both governments.
So the idea here is that but financial institutions can invest. So Fidelity can invest, and then shares of Aramco can be components of their funds, and then you can invest in a mutual fund that has. So that's how it can touch American investors. But so they're looking for money from foreign, institutional investors, from hedge funds, from pension funds, from sovereign wealth funds, from, money markets, all that kind of stuff. But this distribution and the distribution of income is exactly the issue that is so concerning, because what they're essentially saying is it's almost functioning more like a tax. It's not like saying we're going to bring in foreign money into the kingdom and it's going to make us so much wealthier. It's basically saying, like, Saudi citizens who are of like potentially like middle income,
right,
invest your money in this company. That money isn't even going to go to the company. It's going to go to the sovereign wealth fund. So it's basically like saying, give your money to the government.
Right. And the other thing would be is that once Aramco has it, they can probably, I haven't read their dividend. If they have a dividend, I'm sure they've laid that out there, but they could change from having a dividend to not having one. And so,
yes.
you
So remember, it's not Aramco. Aramco doesn't get the money, and it's the Saudi government. So, like, Aramco is not making the money here. The money's not going there. The money's going to Saudi government. We believe it's going to the PIF. They're not totally clear on that. But yeah, so they claim that they've guaranteed a certain like total amount in dividends. It's going to go to dividends. However, they can say that, but like, say they change their mind. Right. Are you going to sue them?
Right. What are you going to do?
And what, like, how are you going to do that in Saudi Arabia?
Yeah, it probably won't end well. I'm just going to say that if you make too much of a fuss about it. So,
or it just won't go anywhere, because like if you're, you can, like I had a New York Times piece that came out about this.
Yes, I know.
Not to like toot my own horn too much, but like, it's the New York Times. So I'm going to just go out there and say it. That basically argued that there is no real rule of law in Saudi Arabia, and shareholders have no legal recourse if something goes on that is contrary to the fiduciary interests of the company. Mm-hmm. So and so that you have to really think twice about this, and the way that if your money is touching this, that it's healthy. If you own shares in a mutual fund that has Aramco as part of that mutual fund, like, you're investing you're giving money to the king of Saudi Arabia. And I'm not saying people should, people make all sorts of questionable moral decisions all the time when they invest. Mm-hmm. Like, that's the nature of making money. Mm-hmm. But people should realize that that's what's going on here. The money that's invested in this IPO is not going to the company.
And I think
going to the government.
I think, to go back to something from a minute ago, if you do see one of these big funds that goes over there and allows U.S. investors to access it through the fund, I will be curious to see, A, how they present it to the people that they are representing, but then B, if it goes south, what potential litigation might come up, because it's going to be hard to convey the message the way that you are and get a lot of buy-in from U.S. People who are wanting to put into that particular fund. If it's the common citizen, because we do have certain laws. I know the SEC is thinking about changing some of this, but especially around accredited and non-accredited investors. And so if you start getting non-accredited investors investing in these funds, and they didn't realize very clearly that the money was going to the king and to the Saudis, not to the Aramco, that could be some massive litigation potentially down the road. Now, these institutions have a team of lawyers who are super smart, but still, it seems like you're almost playing with fire because of all of you'd have to say it so often, people would almost be deterred from wanting to do it. Yeah,
and then I said it in the New York Times. So.
Well, and that's the final authority. That's the final authority for all things. So.
Oh, it totally is. Everybody knows that.
Okay, I'm gonna put this on the record now.
It's not like fake news or anything.
It's not fake news. I'm gonna put this on the record right now. Ellen Wald's New York Times piece will be brought up as evidence against some big bank as proof that this was out there for the investment managers to know. I'm going to get it on the record now that this will go down, and maybe this podcast, and they're like, what,
oh my God, that would be awesome. Hopefully they won't call me to like testify or anything.
They call me. I'm like, just talk to Ellen. I don't know. Just call her up. So, okay, we do have.
He doesn't know me in that
case. Okay. Anything else that you want to touch on this? We had one story about the Frackers, and we have Dr. Foreman. So we got about 7 minutes. So if you want to stay on this, that's fine. Anything we didn't hit? If not, we'll go to the Frackers. You tell me.
I'd really like to go to the Frackers because I think we'll probably be talking about this Aramco IPO for many weeks to come.
Sure, and we'll hit it when we come back. The Monday of Thanksgiving week, we'll be back, and so we'll have some more stuff there. Let's talk about the frackers from the Wall Street Journal. Frackers prepare to pull back, exacerbating a slowdown in U.S. oil growth. Shale companies change course as financial pressure mounts. I don't think OPEC has to worry about much more U.S. shale growth. I did see a group that I used to follow. I'm not following now, but I did see him put out a thing about the boy who cried wolf and how they were not the boy who cried wolf this time, but the previous 2 times they were the boy who cried wolf. But this time was different. And they're essentially saying that they've kind of predicted some of this before, but now, hey, we're right this time. I know we got to talk a little bit offline about some of the concepts with the messaging around the fracking stuff, Ellen. The third quarter results have come out. Some of them have been bad. Some of them have been overly analyzed, in my opinion, but I'm curious, what are your thoughts about these headlines as they stand today?
I mean, like, doesn't the Wall Street Journal write the same article like every other week?
I think it's every week, yeah, but it could be every other week.
Every week, okay.
Yeah, it does seem that, but I
mean, no offense, and like, I know it's a beat, like this is someone's beat, but like, I mean, come on, like, haven't we heard the same exact thing? It's down, and then you go and I think we should obviously ask Dr. Foreman about this, but I was looking at the preview for the monthly statistical report, and it's like U.S. production at 12.6 million barrels per day. Even if it falls off, like, how far down is it actually going to fall? Because we're at 12.6. Like, are we going to fall to 12?
Right.
11.5? I mean,
right. Right.
Like, let's be realistic here.
And this is what's the frustration, and I think it's probably because it's the actual hard work these journalists would have to do. But the frustration from my standpoint is that the production, we keep talking about the rigs going off. We got the DUCs, which we talk about, but let's assume all the DUCs are there and they're all coming on. They eventually will go away. The rigs are going down. Unless there's some kind of economic crash, the price has to go up. I mean, it just has to go up at some point. So are you saying that these companies cannot wait that long? Okay, that's a viable opinion, that these companies cannot wait that long. But if those companies cannot wait that long and they will go out of business, which you're talking probably 6 months, maybe a year, but 6 months or so until this happens, if that happens, then it would seem to be that there would be a lot of these big companies who are nicely positioned in the Permian, probably strategically, to go and scoop up those assets. And so as the price rises, has ExxonMobil told us what they would do if, 30% of the operators in the Permian went out of business and they scooped up 15% of those assets? Have they told us? They haven't told me. Maybe they told someone. And so it's those type of things when you start parsing out. It's like, well, I don't know what any of this means. Okay, yes, it is slowing down. Yes, it will go, but the price will go up. And when the price goes up, what will happen? If you knew that answer, then that would be great. But that answer is not obtainable. So it feels like this is the easier thing to say than to say, well, this is where we're at. We really don't know what's going to happen because there's too many variables in play.
Yeah, no one likes that answer of, we don't really know what's going to happen because there's too many variables. But I really do think that that is the best answer at this point, because saying anything else would just be so untrue, or there's so little evidence to support it that the only thing to really say is there's just too many variables to know. But nobody likes that answer. That doesn't sell reports.
It doesn't sell reports. But I actually think that would be good pieces. Like, if you wrote a theoretical piece that said, what would happen if you took the top 30 producers and you wiped out the bottom 20%. What happened if ExxonMobil and Oxy and whoever else, Chevron, what happened if those three companies picked up the bottom 15% of production? And you looked at the acreage. How is it compared to the current acreage? You looked at historical things, what they've done when price fluctuates. I think those are actually interesting things to explore. And you just come away going, okay, this is something that might happen. It might not happen, but that's an interesting thing. I think that actually listeners and people, at least in the oil field, those are things that they're curious about. What I don't know what would happen if they did that. That'd be interesting, because there's a lot of things that you can actually contemplate then, where this is just like, hey, shale bad, price down, we all go away.
Yeah. You could also say something like, you could also look at something like here are signs, here are some additional signs that X is going to happen, and here are some additional signs that would lead you to think that Y is going to happen. And that way, even if you're not saying like this is definitely going to happen, you're saying, like, if you keep an eye on X and then you'll see A, or keep an eye on Y and you might see B. and that might actually be useful to people.
And a great thing right now, and I know there's been some articles about Chesapeake. I hadn't seen all the stuff, but a great piece right now for those journalists out there listening would be to break down the Chesapeake assets, where they're at. They are, I haven't checked this morning, they were still below $1. So if they keep it up, they will be delisted. I'm not saying they will or won't be, but if they do keep it up, they will be delisted. Let's see here. They are still under the dollar threshold, so 26 more days. They will be delisted. And they may sell or whatever, but that would be interesting right now. What assets does Chesapeake have that they've claimed? What's the viability? How much have they drilled? What are some potential companies that might actually be interested in purchasing those assets? Those are things I think that are actually quite fascinating, especially when you look at something like Chesapeake. There's a lot more tangible information that you can take out. Instead of saying, the shale producers X, Y, and Z, when you can actually do a little bit of work and actually break down some of this stuff, I think that would be helpful and informative, and something I would like to see, to be quite honest with you, because Chesapeake, they've been around, they've had tons of assets, they've sold some up to Total and sold some up to these guys. And I don't know where they're at right now with their assets, but I am genuinely curious, because if they get delisted, and they file for bankruptcy and all this stuff happens, what could be some of the things that you would see, and where are their acreage plays, where are their assets at, and how does that relate to other companies? That, I think, for you journalists out there, would be free content that I just gave you that would be interesting to your readers. I mean, what do you think, Ellen?
Oh yeah, I think that would be really, really compelling, and would be really, really interesting to the rest of us who are looking at this and we're saying, okay, great, you wrote the same thing last week, and you wrote the same thing the week before. And give us some new information here. I mean, maybe it's kind of beyond what people do for newspapers, but I just think it would be really, really interesting, especially because we keep hearing energy dominance, and then holy shit. And then suddenly we're like, Chesapeake's, stock is barely worth enough to keep it on the exchange, and all these companies their share prices are down, and yet we're still seeing high production. There's this disconnect, and the fact that it's occurring is less interesting than what's going to happen. What's the aftermath going to look like? And it would be much more interesting to see someone parse out, here are some potential avenues and potential directions this could take.
And once again, we have on Dr. Dean Foreman with the API coming on to talk about their monthly statistical report, which will be out Thursday the 14th. We actually got the advanced copy again this month, so it's good to be back. Good to be back ahead of the curve. Dr. Foreman, how are you doing, sir?
Doing great. Hi, Ryan. Hi, Ellen. How are you?
We are back from our various global adventures. Put it that way.
Well, let's get started. Ellen and I were talking briefly about the report. I believe it was on air or off air. I can't remember now, but we just referenced that. Your report will indicate on Thursday that a new record for crude oil production of 12.6 million barrels per day, which is number one in the world, will be coming out on Thursday. And there's a lot of narrative about the slowing production. I know we got the DUCs and we've got all these various things that go into this, but Dr. Foreman, it feels like every time we anticipate your report to say that stuff's going down or worse, you come back and say, no, it's actually staying the same or getting better. What can you tell us? Did this number surprise you? Was it kind of in line with where you thought it would be? What can you tell us about that?
This month was a bit of a surprise because we have been tracking for consecutive months now the slowing of drilling, and we know some drilled but uncompleted wells, as you mentioned, are coming to market. But with that slowing, and it has been a pretty big drop-off in drilling activity, and we know the near-term deliverability, how fast it is that you go from beginning to drill to getting this oil to market. Wow, 12.6 million barrels per day of crude oil production in the United States in October. This isn't just a small increase. I mean, it's going up a couple 100,000 barrels per day over that period. So we had been creeping up maybe 100,000 barrels per day per month, and here we get like twice that jump in a month. So it really does suggest that productivity, as the U.S. Energy Information Administration has continued to track, that productivity has remained strong at the same time as these crude oil pipelines, especially coming out of the Permian Basin, are increasing the deliverability of Permian Basin crude oil. So, it is a pretty strong indicator for the health of the U.S. Oil and natural gas industry, especially in the Permian Basin.
One quick follow-up on that. We had a report come across our desk maybe 2 weeks ago. Ellen, I think I sent you something about it. But it was from Raymond James, and one of the things they said was at current pipeline capacity in the Permian, it would take 1,400 shut-in wells to fill up the capacity. And you're seeing some headlines. Some midstream companies are struggling right now. As we see the production numbers increasing or staying the same. What do we think that's going to impact the midstream market? Because for so long it was, hey, we're waiting on the pipelines. Now we've got too much pipeline. But with these high numbers, will we fill these pipelines up maybe sooner than we anticipated?
Well, that's certainly a possibility. I would maybe take exception or debate whether or not we have too much pipeline capacity at this point. I mean, we're still sitting with a price differential between international Brent crude oil prices and West Texas Intermediate, either at Cushing, Oklahoma, or at Midland, of $4 to $5 per barrel. And that's a pretty healthy difference that more than covers the cost of transportation at this point. So you start to get on the margin, people are using either rail or truck to get it there. And we're expecting with Gray Oak and Cactus II and other startups this quarter that by the end of the quarter, we will have increased the crude oil pipeline egress out of Permian Basin by some 1.5 million barrels per day. That's not all on stream here sitting as of mid-November. More of it's yet to come. And as that comes, one would expect by market fundamentals that should increase. There are really two things going on, right? If we look at the difference between international Brent and domestic WTI, the improved egress or pipeline capacity coming out of the Permian Basin should make it so that the crude that's in places like Midland that in the past maybe had to find its way through the Cushing hub, and then there's some bottlenecks that degrade value, that being able to go more directly to coast and to refiners should improve the pricing efficiency of West Texas Intermediate coming from, Cushing, but also Midland and other places. Now, on the other side, when we look at what's happening globally, and this is where the Saudi and other events come in, if we look at a mix of what's been happening of why Brent crude oil prices are what they are, Brent crude oil, the benchmark is, of course, a blend of different crudes, right? And the 40s part of this, a lot of the wet gas, there's part of the Brent benchmark that's been staying more locally and being refined locally. But it's really the 40s component of that index that's been setting Brent's price. And in particular, that's being pulled by China that's wanted lighter oil that it can't get from Saudi Arabia at this point through Saudi light being taken off stream by the attacks of a couple of months ago. So, as China bids that up, and at the same time as you get this Permian egress, at some point that sets up a bit of a sandwich where you could look for dynamics by, again, economic fundamentals for that to close a bit.
So, I'm sorry, Ellen, can I ask one more quick thing, just real quick, sorry about that. You mentioned that the price differential, we have IMO 2020 just around the corner. Does that factor into the differentials that you're talking about on top of some of these other issues?
That's a different issue altogether because the tightening of the sulfur fuel specifications, in particular for marine fuel, other things being equal, that should increase the amount of demand for ultra-low sulfur diesel in marine applications and decrease that for residual fuel oil. And we've kind of been sitting watching the inventory data to see if we have a stockpile building of residual fuel oil that can't find a home. And as of October data in the inventories for for residual fuel oil, that's not showing up yet. And the need for heavier oil, in particular from Canada, Venezuela, Maya coming out of the Gulf of Mexico, that helps with a little bit heavier than the light oil that we've got that's really coming out of the Permian Basin. That gives you better distillate yields, those middle distillates that you're looking for. And look, we've got refiners that are selling product forward globally through mid-next year and seeing premiums for it. There is a market reaction that's budding for that. But right now, it's not clear that there's a shortage of the ability to produce it. It sure looks like the market's working very efficiently to try to address the situation.
I just wanted to clarify this a little bit because regarding the previous comment about Brent crude oil pricing, so are you saying that essentially what Brent is being the price of Brent is actually higher perhaps than it should be if the market were being more efficient in terms of the direction of or the flow of light crude oil. So it's the Brent prices are higher because China is willing to pay more to get light crude from Saudi Arabia as opposed to, say, buy that light crude from the United States. And if we do see a shift in China's the particular type of crude or the source of the light crude that China wants to buy, we could see Brent prices actually drop because they will no longer be bidding up that particular component of the Brent benchmark. Is that what you're saying?
You recapped it really well. That's about right. And it could work out other ways, but right now that has been a go-to source for them. And as the ability to diversify the supply source happens, you'd expect some pressure to be relieved off the prices.
That's a really interesting idea. I'd never really considered that. That Brent, because people are so focused on how low Brent is, whereas what we're saying is actually Brent is actually being kept up a bit higher than it should be. That could be say we've got these pipelines come online. Say China and the U.S. magically work out their trade differences, and suddenly they're like, hey, yeah, we'll buy an extra VLCC of light crude from you every month. Well, there goes the price of Brent.
Well, as the typical caveat, API can't predict the price for you.
Of course.
Directionally, that's the fundamental, right? And this is the way, with things having been taken off stream, we have to point forward, kind of take stock of where we are and say what could change. And you're right that opening the floodgates to more business with a breakthrough on trade could go that direction.
Uh-huh. Who knew? Well, people should keep that in mind. That there's a sleeper issue in the price of Brent.
Absolutely, but we're talking about the difference between Brent and WTI. Right. And if we clear the clouds over trade, and the global economy is cushioned as a result, and some of that helps clear broader clouds, risk on, risk off, we could see the whole oil complex do better and be viewed in a more positive light as a result of that. So look, we always look at the relationship between global economic growth and oil demand as being one of the primary things. And right now, it's been pretty constructive this year, despite a lot of economies being really under stress this year. And the consensus expectation is this starts to bounce a little bit next year. So it's going to be a really interesting time to see where it goes.
I have a couple. Okay. So one thing on that, real quick. I was listening a week ago, and I think it was on Bloomberg Radio. It wasn't Ellen, unfortunately, but it was several economists, and it was an interesting sentiment, Dr. Foreman, because they talked about that whoever these people were that were coming on Bloomberg, but there was a multitude of them that were saying, hey, you know what, we feel that the global recession is not necessarily over, and not that they're not, well, the fears of the global recession, the setback, aren't as bad as we thought they were, and they could start to see an uptick in the global economy. Now, we've talked a lot about the impacts of that, and it was the first time I've heard these fund managers or whatever, I can't remember, it was 2 or 3 different people that had these opinions. Y'all have y'all's economic indicator. Where are y'all kind of at on that? Do you think that maybe the recession talk that dominated the past few months is kind of dwindling away and people are seeing the light at the end of the tunnel, or is it a little premature to kind of put those eggs in that basket?
It honestly is a little premature, but we can say with the Federal Reserve acting proactively to cut rates last week, that effectively this insurance cut of rates is trying to cushion the market, right? Trying to support asset prices, trying to support economic activity. And if you get the breakthrough on trade, that'll help. But Japan and Germany are technically in recession right now. The UK, instead of growing close to 3%, typically is growing just around 1%, a little above. And next year expected to get worse with Brexit, right? And then we get into the emerging economies, and they take all of Latin America pretty much, Argentina, Brazil, Ecuador, Peru, Chile, on down the line, a lot of stress. And that doesn't include Venezuela, which is absolutely in crisis. And then we get to Asia, and it's relatively better, but because of the trade frictions and other things, China has still slowed to some 6.2% this year and expected to go sub 6% by the consensus next year to 5.9%. So you start adding this up, yes, fewer economies are expected to be in crisis or deep recession next year compared with this year. If we look at some 200 countries, for example, only 35% of them in 2019 have seen their growth for consensus expectations grow year on year, or increase in velocity. So a growth amount that's larger than in 2018. Going into 2020, that number goes above 50%, and again in 2021. So it's not a big difference. It's sort of flatlining from here, creeping up 0.1% per year. But that's enough to usually stabilize the global economy and think of global oil demand increasing in tandem. The challenge actually is that the U.S. economy, even by official estimates, is expected to continue to slow for the next 2 years. And that divergence between global and U.S. economic growth historically has had some implications.
Okay, so on page 5, you have generously made a page that I can understand. It's got a lot of charts and colors and very simple for someone like me to understand, except for I don't actually understand the implications, so I need you to help me out here. We have a lot of charts. Let's kind of weave some of these together here. The exports, it looks like, is down over the last, if I'm reading that right, the last 3-4 months. The imports took a nice sudden uptick. Now, if you look at that and you compare it to the inventories and the crude oil stocks, there's kind of an interesting dynamic there. What's going on? Kind of paint what's going on the import-export side, and then compare that with the inventory, and what conclusions should we draw from this?
Well, the headline and what we put in the synopsis is that here we are several consecutive months with petroleum exports from the United States above 8 million barrels per day. So if we take any month-to-month noise out of that, that's pretty steady in terms of export performance. So good on exports, right? That's doing its job. And it's mainly been, if we look year to year, it's been crude oil exports have been growing rather rapidly. And on the product side, with slowing of the global economy, we've seen some of the product exports from the U.S. They're down a little bit month to month, but year to year, it's almost 800,000 barrels per day. So there is a pretty good dynamic that gives you a picture of end-use consumption versus taking crude oil for refining. And there is a pretty voracious appetite for U.S. light sweet crude oil globally. On the import side, we celebrated in September how U.S. net petroleum imports had fallen, both because of increased exports, but then an absolute decrease in the imports. The gross imports of oil. And we had some backsliding of that in October where the imports blipped up a bit, but there is some seasonal noise in this. Some of it depends on the location and the quality of the crude oil in question, but it's not a stratospheric change. These are still the third lowest imports for October since 1995. So now, fast forward, as you asked, into inventories, and basically for a whole year, 12 consecutive months, we've seen year-on-year growth be positive for inventory accumulation. So most of that has been on the product side, despite crude oil exports have continued to grow. But even on the crude oil stocks, they're still the highest for the month for October since 2017, and they increased month on month as well. So that's a testament to this production message that we started with of the 12.6 million barrels per day, that as long as that's continuing to flow into the system, the market's absorbing it and finding creative ways to use it. Now, I think there are some interesting subplots between what's happening with Canadian heavy oil and what's happening with Maya and Maya Gulf of Mexico, Northern Gulf of Mexico crude oil, which is heavy, and then Venezuelan crude oil heavy, which is continuing to drop. And then as we talked about, WTI at both Cushing and Midland relative to Brent, when we start looking at the whole complex of all these oil price differentials, we're starting to see some of the differences in value between different qualities and locations of crude oils go toward their tails, meaning that if we're looking at the top or bottom 25%, say, of value, those differences compared with the last 5 years, they've moved to some relative extremes. So this tells us that we're facing some structural changes in the market potentially, and some interesting shifts both in global economic activity, but also where refiners are drawing from. So markets will work. This is playing out in real time, but it's definitely a very interesting set of undercurrents below what otherwise might appear to be a pretty simple top-line story for the market as a whole.
Yeah, and then one more thing is refinery capacity utilization. I think you put in here it was at 85.5% roughly, if I remember correctly. But if you look at the 5-year range, it's really almost, you got a circle, it's kind of hard to tell, but it's almost outside of that. So is there a culmination of things, or is this is it just, hey, we just had kind of the perfect storm where a lot of refineries just happen to be due to be down, or is there something else we should read into that kind of extreme note there?
Well, I think this is one of the short-term exceptions, right?
Okay.
Because we had been, as of September, celebrating the fact that the utilization rates by U.S. refineries of their capacity had been reaching really the highest of levels through 2019, and we recognized relative to the year prior in 2018 that the dearth or shortage of being able to get enough heavy oil was idling some capacity across the U.S. Gulf Coast, which just couldn't get enough of it from Canada to offset with what was being lost elsewhere. Now, here we go, 85.4% utilization rate, abysmally low, actually, compared to the 5-year range, really going off the bottom end of it. And it's really a result of some localized concerns about pipelines in particular and taking some capacities offline. We've had some other incidents that have basically idled capacity. So, look, this is normally a time when you'd have some turnovers. On top of this, we've had some outages, some 1.5 million barrels per day of crude oil distillation capacity taken off stream by Bloomberg's estimates. So this should come back relatively quickly, one would hope, but it certainly made a mark for the month of October.
Okay. I have one more, Ellen, but if you have one, go ahead. So, final question for you, Dr. Foreman. We see that in October, kerosene jet fuel demand was up 1.9 million barrels a day. How much do you directly attribute that to Ellen and I traveling the world? It seems that it's probably the bulk of that should be owed to us, the credit for that, right?
Well, each time you jump in that plane, you're definitely supporting the whole of the energy complex as well as the global economy. I think that the top line thing in this month's report that was really phenomenal, not just jet fuel and how strong it's been, was that total U.S. petroleum demand was some 21.2 million barrels per day. So here we are worried about a global recession, potentially. It's certainly a slowing global economy. Yet in the U.S., we have the highest ever petroleum demand in total for the month of October. It's pretty phenomenal. And jet fuel has done well. Gasoline has held up. It's kind of flat on a year-to-date basis, year-to-year, but it's only flat because it's really accelerated the last couple of months. Distillates have done a little bit better, not a lot. That side of the economy is still weak, and that shows up, as you mentioned, in our economic indicator. But other oils, so naphtha, gas oil, a bunch of things that go into refineries and petrochemicals, those have very quietly continued to grow this year and have done really well. So this says the demand for materials, for fuels, and that has been pretty voracious as the global economy has grown. It's a global demand, not just the U.S. demand, but from a U.S.-only data perspective, we're still seeing underlying strength.
Okay. Well, Dr. Foreman, is there anything that we missed today that you wanted to highlight, or something that the listeners should be anticipating or looking for in this report? Or as we get ahead, November's here, but December's just around the corner. Anything that we should be expecting coming just a month from now?
Well, it's hard to look forward and anticipate exactly where things are going to go. I think we should celebrate the fact that with these really high exports, the typical antithesis to our industry has been, if we export, prices will go up. And here we are hitting on all cylinders in terms of exports and net exports, yet the prices have continued to fall. So that's an important thing to take stock of. On top of this, and we hit this in the highlights for our monthly report, will come out on Thursday, but the Washington Nationals capturing the World Series championship, phenomenal. And we likened it to really what's happened in our industry, where we're seeing these unexpected turns and trends. And it really is the whole industry through the entire value chain, from resource development, through infrastructure, through export infrastructure, refining, trade, all of it kind of hitting on all cylinders. And performing in a rather unexpected way.
Okay, API.org is the website at the top right, Chief Economist. You can go see Dr. Foreman's work there, past reports, future reports, all the stuff that he puts out is right there on the website. Dr. Foreman, it was great to get you on. Ellen and I will, if you want, since you're in D.C., if you want to tell Trump to give us a Presidential Medal of Freedom or whatever we get for increasing the jet fuel demand, we'll be happy to take that. That's no big deal for us. And I'm going to China, so I'm doing my part. I'm continuing. And Ellen was kind enough to go and get the Aramco IPO launched. So while she was in the Middle East last week, so we're just doing our part to spread the good news of energy. And I will probably sign the trade deal while I'm in China. I'm anticipating to get that done. So. It's good.
It's all good. We're making the global economy go round.
Yes.
Excellent milestone. Yeah.
It's good to have you on. We look forward to talking to you in December as we wrap up 2019. It's hard to imagine that it's already here. It feels like we've been talking about IMO 2020 forever, and then I'm kind of looking forward to these first quarter reports coming out next year where we see what impacts IMO 2020, who's in compliance, who's not in compliance, all the stuff. And I'm sure you guys will be tracking that from various angles and all the things that will come along with that. And the DUCs, we're going to see what happens with these DUCs sooner or later. So, Dr. Foreman, it was great to have you on. Thank you again for your time today, sir.
Great talking with you both. Thank you.
Thanks again to Dr. Foreman for coming on and for the report they send us every month. That is one of the things I do enjoy getting to look at and talk about and dissect, because I get to ask all the silly questions and you get to ask all the smart questions and he gets to give us all the smart answers. And so between that, we we get to learn a lot. And it's so fascinating because, you kind of think, okay, this is what I think is going to happen this month, and you see the line going up and to the right, and you thought it was going to go down to the right or whatever it is. And so I'm always fascinated to see what might or might not come of that. So anyways, Ellen, I will be in China. That's where I will be for the next week and a half. I leave for China Wednesday, get back the following Friday. In the meantime, so for the next couple of weeks, where will you be so the listeners can tune in and follow along with what you have going on? I'm sure a lot of Aramco IPO talk on Bloomberg and Investing.com, Forbes, and Wall Street Journal, New York Times, Drudge Report.
Wall Street Journal. So, if I ever make the Drudge Report, then I can die happy. That will be the pinnacle of my career.
Depends on what it's for.
That's true. It better not be something bad about me. For something I've written.
Right.
A reporter friend who writes for AFP had one of his pieces retweeted by Donald Trump, and that was his. He said, "I've made it. I can go home now."
That's funny.
So where am I going to be? I'm going to be on investing.com and definitely Forbes. I was weighing in on some of the details of the Aramco prospectus on BNN Bloomberg. That's in Canada. So love my Canadian friends there. And I'm sure I'll be elsewhere now that I'm back. I can accept more media appearances because apparently in the United Arab Emirates you can't use Skype, and that really limited the media appearances I could do. Oh, I'm also going to be on Vox. I will include a link to that podcast in the show notes.
And you had on Twitter a link to some reports that your consulting firm has been releasing.
Yes.
Can we link to those in the show notes as well?
Yes, absolutely. We've got 86 questions that you need to be asking about the Aramco IPO if that's something that you're interested in. And we've also republished a report that I did a while back about the 2018 Aramco charter that's basically like bylaws and articles of incorporation. And so if you want to know what actually makes this company a company, you can download that too, and I will link to those in the show notes.
And if I'm in the news the next week and a half, I either have successfully signed the trade deal or I am in jail in China. Or the plane crash. That's really the only three options. So you won't hear from me.
Don't end up in a Chinese jail, please.
That won't be very good. So we'll be back the week of Thanksgiving, right, Ellen? That's our next show, the Monday, and then should be back on regular schedule until we get to Christmas, New Year, time of the year. We'll take off a couple weeks for that. Yeah. But we'll have a lot of Aramco talk. I'm sure we have on Gene Epstein coming on. When's he coming on, Nate?
December 2nd.
Gene Epstein will be on December 2nd, so we'll get to talk to him about the inverted yield curve and to see where all of that is at and keep us up to speed. Ellen, it was good to get to talk to you again. Glad you're back. Sorry you're a little bit under the weather today. Hope you get feeling better.
Yeah.
And
Ryan, for your assignment while you're in China is to take the libertarian purity test.
Oh, I took it. I'm sorry. I forgot about that. Okay. You want to go first? Let me go first.
I don't actually remember what I got. I took it a while ago. What did you get?
I got 108. 108.
I'm going to have to redo it because I did it while I was in. I'm looking for my thing. I'm looking to see if I have. Here we go. Here it's on my phone. Okay. Oh dear. It zeroed my results and now I don't matter.
You're a full-blown communist.
I did pretty well actually. I was like one shy of like you're a crazy like anarcho capital like I was
so we'll okay.
I think we should get Gene Epstein to take that.
Gene
test.
Epstein will be full bore 160 or whatever you can get. So I
think we should give him an assignment. I think he should have to take it and report his results to us. We'll link to that in the show notes.
We'll link to that in the show notes. Here's what we'll do. We'll link to the show notes. We'll take it again, and then we'll discuss our results when we come back for Thanksgiving. Comrade Nate Hansen, I'm not going to tell you what he got, Ellen, but he was the Russians were calling his phone
68.
after the Russians were calling his phone, very excited about his results. So all right, Ellen, good to see you. Good that you're back. And listeners, thank you so much for tuning in, and we'll talk to you in 2 weeks.